Hey everyone! Gearing up for your CA Inter exams? I know AS19 on leases can be a tricky one, so today we're going to do a super focused revision. My goal is to get you so comfortable with this standard that you can tackle any question the exam throws at you. So let's jump right in.
But hang on, before we get into the definitions, let me ask you a question. This is a classic ICI curveball. What if a company could use a massive multi-core machine, get all the economic benefits from it, show it right there on its balance sheet as an asset, and even claim depreciation, all without actually holding the legal title deed? How is that possible? Well, it's not a loophole. It's the absolute heart of AS19. It's this idea of substance over form, and if you get this, you're halfway to mastering the standard.
Okay, let's bring this to life with a typical exam-style problem. You've got Smart Tech Ltd. They need a machine that costs a cool 20 lakh rupees. So they sign a 4-year deal to use one, and they agree to pay 6.25 lakh every year. Now the simple answer is, oh, it's just a rental. But AS19 says not so fast. We need to dig deeper. We're going to use this exact scenario to walk through all the rules.
All right, Section 1, Lease Fundamentals. I want you to think of this section as us building your AS19 toolkit. Every definition we cover here is a tool you're going to need to solve any problem that comes your way. Let's start with the absolute basics. What even is a lease? Well, it's just an agreement, a contract. You've got two main players, the lessor, who is the legal owner of the asset, and the lessee, who's the one that gets to use it. The lessor gives the lessee the right to use their asset for a set amount of time, and in return, the lessee makes payments. Simple as that.
Okay, pay close attention here. This is prime MCQ material. AS19 applies to pretty much all leases, but there are 3 big exceptions you absolutely have to remember. It does not apply to leases for natural resources like oil and gas. It doesn't apply to licensing agreements for things like movies or patents. And this is a big one, it doesn't apply to leases for the use of land. Burn these 3 into your memory.
Next up, a huge concept that drives so many of our calculations, minimum lease payments, or MLP. This is the amount the lessee is contractually obligated to pay. But what's just as important is what's not included. We exclude contingent rent, which is rent that depends on something else, like sales. We also exclude costs for services and some taxes paid by the lessee. Now lean in for this one, because this is where it gets interesting. The definition of MLP is slightly different depending on whose shoes you're in. For the lessee, it's their payments plus any residual value they've personally guaranteed. But for the lessor, it's their payments plus any residual value guaranteed by the lessee or a third party. It's a subtle difference, but it's exactly the kind of trap ICI loves to set. This is where marks are often lost. Now, let's clear up a critical distinction. Economic life versus useful life. Economic life is the total lifespan of the asset, how long it could be used by anyone. Useful life, on the other hand, is just the period the lessee expects to use it. Why does this matter so much? Because when you depreciate a finance lease asset, you use the useful life. Using the economic life by mistake is a classic and very costly error. Let's quickly run through a few more key values. Residual value is what we estimate the asset will be worth at the very end of the lease. Now, this value is split into 2 parts. First, you have guaranteed residual value, or GRV, which is the portion the lessee has promised to cover. The rest is the unguaranteed residual value, or UGRV. So, the simple formula is residual value equals GRV plus UGRV. Okay, this one sounds super technical, but don't let the name intimidate you. The interest rate implicit in the lease is basically just the lessor's internal rate of return, or IRR. It's that one magic discount rate that when you apply it to all the cash the lessor expects to get, that's the MLP plus any UGRV, the present value of all that cash perfectly equals the asset's fair value today. If you can figure this rate out, it's the #1 choice to use in your calculations. All right, Section 2. The key question, classification. I need you to really focus here. This is, without a doubt, the single most important decision you will make in any lease accounting problem. Get this classification wrong, and I promise you every single calculation and journal entry that follows will be incorrect. So AS19 splits all leases into 2 buckets. On one side, you have a finance lease. This is a lease that transfers substantially all the risks and rewards of ownership over to the lessee. In substance, it's like the lessee has bought the asset and taken a loan to pay for it. Everything else is an operating lease, which is basically just a simple rental agreement. It all comes back to that key principle, substance over legal form. So how do we decide which bucket it falls into? Well, AS19 gives us a checklist of 8 indicators. Now, this is crucial. They are not all created equal. 5 of them are what we call deterministic. If even one of these is true, the debate is over. It is a finance lease, full stop. The other three are suggestive. They just provide some extra evidence to support your conclusion. So here it is. This is your exam checklist. The 5 heavy hitters. You have to check these first. 1. Does the legal ownership transfer to the lessee by the end? 2. Does the lessee have an option to buy the asset at a ridiculously low price, a bargain purchase option? 3. Is the lease term covering a major part of the asset's economic life? 4. Is the present value of the MLP pretty much equal to the asset's fair value? And 5. Is the asset so specialized that only the lessee can really use it? If you can say yes to any one of these, you've got yourself a finance lease.
And then we have our 3 supporting actors, the suggestive conditions. These just add more weight to your decision. For instance, if the lessee has to cover the lessor's losses if the lease is canceled, that suggests a finance lease. Or if the lessee gets to keep any profit from the asset's value going up, that points towards it too. They help build your case, but they're not the knockout punch like the deterministic 5 are.
On to Section 3, Finance Lease Accounting in the lessee's books. So we've gone through our checklist, we've decided it's a finance lease. Now what? How do we actually put this into our accounting records? Let's get to the entries. Okay, this slide is pure exam gold. Please burn this rule into your memory because it's a classic IKI trap. At the beginning of the lease, the lessee has to record both an asset and a liability. But at what value? It's the lower of the asset's fair value or the present value of the MLP. The exam question will often give you both numbers just to bait you. Don't take the bait. Always, always pick the lower one. Now, to calculate that PV of MLP, you need a discount rate. And there's a clear hierarchy here. Your first choice, your go-to, is always the interest rate implicit in the lease. If, and only if, it's not practical to figure that out, then you fall back to your second option, the lessee's incremental borrowing rate. That's just the rate the lessee would have to pay to borrow money to buy the asset outright. So, what happens every time the lessee makes a payment? Well, each payment is split into 2 parts, just like an EMI on a loan. A portion of it is the finance charge, which is basically the interest expense. That hits the profit and loss account. The rest of the payment is the principal repayment, and that goes to reduce the outstanding lease liability on the balance sheet.
And here is another huge area where students lose marks: depreciation. Listen carefully. If it's reasonably certain the lessee will own the asset at the end, like there's an ownership transfer clause or a bargain purchase option, then you depreciate the asset over its entire useful life. Simple. But if ownership is not certain, you have to depreciate it over the shorter of the lease term or its useful life. Please get this rule right.
All right, Section 4, Mastering the Calculations. Enough theory. Let's get our hands dirty and actually apply all of these rules to our SmartTech Ltd case study. So let's crunch the numbers. The question gives us a 15% interest rate and a guaranteed residual value of $1,025,000. So we take each payment. Notice that the final year's payment is $7,500,000 because it includes that GRV, and we discount each one back to its present value using the 15% factor. When you add all those present values up, you get a total PV of MLP of $18,55,850. Now for step 2. We use that critical recognition rule we talked about. Remember, the lower of rule? We compare the PV of MLP we just calculated, $18,555,850, with the machine's fair value of $20 lakh. We have to record the asset and liability at the lower amount, so we'll use $18,555,850. The journal entry is then straightforward: machinery account debit and lease liability account credit for that amount. Next up, we need to split that first year's payment. We start with our opening liability of $18,055,850. The interest component is just 15% of that opening balance, which works out to $2,788,378. We know the total payment is $6,025,000. So if we subtract the interest from the total payment, we get the principal portion, which is $3,466,222. Finally, our closing liability is just the opening liability minus the principal we just repaid. And you just repeat this process for the rest of the lease term.
And now for our final section, lessee disclosures. Look, you've done all the hard work with the classification and the calculations. Don't fall at the final hurdle. Disclosures are easy marks as long as you know what to write.
So, in the notes to the accounts, the lessee has to disclose a few key things. You need to show the assets you've taken on finance lease separately from the assets you own outright. You have to show their net carrying amount.
You also need to provide that reconciliation of future payments we talked about and disclose any contingent rent that was charged to the P&L. It's all about transparency.
And this is what that reconciliation disclosure actually looks like. It's just a simple table that breaks down the future minimum lease payments into different time buckets. Payments due within 1 year, then between 1 and 5 years, and finally, anything due after 5 years. It just gives anyone reading the financial statements a really clear picture of the company's future cash commitments for these leases.
We're hitting two of the most critical exam favorite areas, lessor accounting, and you guessed it, the sale and leaseback transaction. Let's get right into it.
Okay, picture this exam question. You've got a machine, its written down value is 40 lakhs. You sell it for 50 lakhs. Simple math, right? That's a 10 lakh profit. So you just credit it to your P&L and move on? Or do you? This is exactly the kind of trap where so many students lose easy marks. Because AS19 has something to say about this, and the answer is a classic, it depends. And what it really depends on is one simple question. Did you happen to lease that same machine right back? That's the twist. And by the end of this session, you'll know exactly how to handle this every single time.
Now, to understand that puzzle, we have to build our foundation first. So let's start with the lessor's books in a finance lease. Just remember, a finance lease is basically a sale in disguise. All the risks and rewards are transferred. So for the lessor, this isn't just a rental, it's a financing deal.
And this is the most important point. As soon as a lessor gives an asset on a finance lease, it's gone from their PPE. It's off the books. In its place, they record a receivable, basically an amount they're owed. And the value of that receivable is what we call the net investment in the lease. Think of it as the present value of all the money they're going to get.
So to find that net investment, we first have to figure out the gross investment. Gross investment is just the grand total of every single rupee the lessor hopes to get. That means you take all the minimum lease payments, the rentals, plus any guaranteed residual value, and you add the unguaranteed residual value, which is the bit of value at the end that only the lessor is counting on.
Okay, so you have the total cash you'll get in the future, your gross investment, and you have its value today, the present value, or net investment. The difference between those two numbers is your profit, right? Well, in leasing, we call that unearned finance income, or UFI. It's the interest you're going to earn over the life of the lease.
Now here is a massive exam tip. This is a shortcut that ICAI absolutely loves to test. You see, the net investment, that's the present value of all those future payments, is by definition equal to the fair value of the asset at the start. So if the question gives you the fair value, you don't need to do any PV calculations. Your unearned finance income is simply gross investment minus fair value. Done.
All right, just a few quick-fire theory points you need to know for the lessor. That UFI we calculated, you don't book it all at once. You recognize it in your P&L over the lease term to show a constant rate of return. What about costs like commissions or legal fees? You can either expense them right away or spread them out. And here's a crucial one on UGRV. If you think its value has dropped, you have to account for that loss immediately. But if you think it's gone up, you ignore it. That's the principle of prudence in action.
Okay, enough theory. Let's make this real. We're going to jump into an illustration just like you'd see in your exam and calculate the unearned finance income from scratch.
Step 1, every single time, is to find the gross investment. So we've got lease rentals of 8 lakhs a year for 5 years, that's 40 lakhs. Then we add the guaranteed residual value of 1.6 lakhs. The total expected value at the end is 3 lakhs, so the unguaranteed part is 3 minus 1.6, which is 1.4 lakhs. Add it all together, 40 plus 1.6 plus 1.4 gives us a gross investment of 43 lakh rupees. Simple.
Now, we need to find the present value of all of that. So we take the rentals, the GRV, the URV, and we discount them back at the given rate of 15%. And look at this. The total present value comes out to 28,30,920. Now, what was the fair value mentioned in the problem? The exact same number. This just proves that our shortcut works every time.
So now, the final step is a piece of cake. We take our gross investment of 43 lakhs. We subtract the net investment, or fair value, of about 28.3 lakhs, and that leaves us with our total unearned finance income, 14 lakh 69,080 rupees. And that's the amount that will be recognized as income over the next 5 years.
Okay, let's switch gears completely. We're moving from finance leases to operating leases. And believe me, it's a whole different ballgame. If a finance lease is like a loan, an operating lease is what you'd call a true rental. The accounting is way simpler, but it has its own little traps.
This slide right here is your ultimate cheat sheet for operating leases. It's super simple. For the lessor, the asset never leaves their books. It stays as PPE, and they keep charging depreciation on it. For the lessee, no asset, no depreciation. The most important thing to see here is that for both of them, the lease rent is recognized on a straight line basis. It's income for the lessor and an expense for the lessee.
And this is the core idea you have to grasp. AS 19 says you must recognize the income or expense evenly over the lease term because that's how you're getting the benefit. It doesn't matter what the cash flow looks like. So if your rent is 1 lakh the first year and 3 lakhs the second year, your total is 4 lakhs. You have to book 2 lakhs as an expense in your P&L each year.
So you might be wondering, what happens to the difference between the cash you actually paid and the expense you booked? Well, that difference goes into a special temporary holding account. We call it the lease equalization account. It's a balance sheet item, it can be an asset or a liability, and its whole job is to balance things out. It will eventually become zero by the end of the lease. This is a really important detail for journal entry questions, so don't forget it.
And here we are. We've come full circle. With everything we've just learned, we can finally solve that puzzle from the very beginning. You sell an asset, and then you immediately lease it back. What do you do with that initial profit or loss?
Here is your 3-step foolproof plan to nail any sale and leaseback question. Step 1, and this is the most critical, figure out if the leaseback is a finance lease or an operating lease. Step 2, compare the price you sold it for against its actual fair market value. And step 3, based on those two answers, you just apply the specific AS 19 rule.
Now there are two main paths. The first path is super easy. If the leaseback is a finance lease, then in substance, you haven't really sold anything. It's more like you took a loan using your asset as security. So any profit you make has to be deferred and spread out over the lease term. But path 2, the operating lease, that's where things get interesting. And that's where ICAI loves to set its questions.
So let's use a real example. We've got our machine with a written down value of 40 lakhs. We're going to walk through a few different scenarios where the sale price and fair value are all over the place, and you'll see exactly how the accounting treatment changes for each one.
Okay, this table is your secret weapon. Let's look at case A. The sale price equals the fair value. This is a straightforward, genuine sale, so you book any profit or loss immediately. Now, let's slow down and look at case D. You sell it for 50 lakhs, but its fair value is only 40 lakhs. That extra 10 lakhs you got isn't a real profit. It's basically a loan from the buyer, which you're going to pay back in the form of higher rent. So that excess 10 lakhs has to be deferred and amortized. Just remember this logic. Any profit up to the fair value is real and can be booked now. Any profit above the fair value is just financing and must be deferred. Pay close attention to cases E and F. That's where you have to split the profit. The part related to the fair value gets booked now, the excess gets deferred.
We're in the home stretch now, the last little bit, and this is an easy way to pick up some extra marks, especially in theory questions, is disclosures. Please don't ignore this part.
For the lessor, you need to remember a few key things. For a finance lease, you must show a reconciliation between your gross investment and the net investment. You also have to disclose your unearned finance income and your unguaranteed residual value. For an operating lease, it's different. The asset is still yours, so you need to disclose its book value, the depreciation you've charged, and a schedule of the minimum lease payments you expect to get in the future.
So let's wrap this up by going back to the beginning. You're sitting in the exam hall, you read a line that says, an asset was sold for a profit. What's the very first question that should now fire off in your mind? It should be, wait a minute, was there a leaseback? Because now you know that one little detail changes absolutely everything.